Chris Preston.
And I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. Different two people last week, Brad. Good job, you and Madison. Good chat on saving for college. Is it true that I'm starting to feel a little bit like the Biden to Madison's Kamala Harris? Are you trying to Nancy Pelosi me out of the podcast here?
No,
Yep. See ya.
I was gonna say no. You're here to get us back on the rails. Last week was a wild one. Maybe it was just a fever dream. I don't know, but no. I have one co-host. I'm a podcast. What's the word I'm looking for? Not purist. I have high levels of commitment to my podcast co-hosts.
Monogamous.
Yeah, I guess, but that's not entirely true.
Yeah,
as last week evidenced.
Yeah.
But let's talk about actual stuff that matters and not my level of commitment to you as a co-host.
Yeah.
All right, so I'm gonna go through the rundown right now.
Yeah.
This week we are gonna start with a conversation about the massive VIX spike. It was the highest levels we've seen in years. We are going to talk about recession fears. Are those overblown? Are people right to be concerned? And we're going to talk about the Japanese carry trade a little bit, what it is, what we saw with the Nikkei losing 15% intraday on sort of the Monday overnight and then closing down about 10%. And then after that, we're going to be joined by Ben Reynolds, the founder and CEO of Sure Dividend. And we're going to talk all about dividend stocks with him. So looking forward to that.
Yeah, and before all that, as always, we have a defend the take. And Brad, you're up this week, and your take, for which you have 90 seconds to defend, is that bad news is bad news again for the market. Explain yourself.
So we have spent the last almost a year now where bad news has been good news, right? Signs of economic weakness, signs of weakening consumer, weakening labor market was all sort of part and parcel with the Fed rate cuts coming in. That has been a big driver for some of the risk on sentiment in the market. But as we'll get into with the sort of unwind of the Japanese carry trade, that was something of a black swan event that really seemed to reset the mindset of market participants. The bull bear ratio, this came from, this was shared internally by Michael Brush of Cabot Cannabis Investor, down to 2.51. That's on a 0 to 5 scale. So it's not so bearish that it's like a screaming buy signal, but it is showing that investors are becoming more sensitive to evidence of economic weakness. I think that what we have seen in the course of, honestly, almost the last month since the market topped out at the middle of July, is more sensitivity to risk. There's not really, I mean, there's been a lot of discussion about emergency Fed rate cuts. I don't see that happening. There's not really a way to accelerate that as like a bull thesis, as a bull catalyst. So we're at a point now where those fears of recession are creeping in, where the market technicals are weaker than they have been, where there is the fear of the outside sort of black swanny event. And I think collectively that's enough to make bad news once again. So if, say, next week we get continuing signs of weakness in the labor market, that's likely to prompt a negative market reaction instead of in the months, almost the entire first half of this year, where that prompted bullishness. So I think there's been a change of character in the market. It's still not run to the exits, but there's definitely more economic sensitivity and more headline sensitivity than what we've seen thus far this year.
Yeah, gave you about 2 minutes there, but that's fine. Yeah, no, I agree. It's so like you're right in the sense that, well, you're right, but for months, a couple of years really, people were almost rooting against the economy, at least against like jobs reports and unemployment reports, and not against like earnings or anything like that, but because it would mean, okay, makes it more likely for the Fed to cut rates. But now we've arrived on the doorstep of Fed cutting rates, and everyone knows they're going to cut rates basically they're going to cut rates next month. this is the timing is, the fact that it came right on the heels of them not cutting rates in July. Now it's completely flipped. No one is. It's almost like you're driving somewhere to meet someone and you're early and you almost root for traffic for a little while, but
Yeah.
then you enter too much traffic. You're like, okay, I got to get going here. It's kind of, that's my bad analogy for it. But yeah, you're right. The mentality has flipped and people are like, let's go ahead and cut the rates. I hope you're not late for, and we'll talk, a little bit about whether they are or not. I hope you're not, too late here. But let's go ahead and get this, rate cutting program started before we hit a recession.
Yeah. Yeah. I mean, certainly in the headlines, you're not seeing nearly as much conversation around inflation as being like this big risk anymore. Now, every headline is about economic weakness.
Mm-hmm.
The Fed in the July Fed meeting, um, Powell was fielding a lot of questions about like, hey, are you guys, did you miss the boat? Are you late on this? And I think we'll probably dive into that a little bit more later, but that does seem to be the fear that's driving people is the actual implications of a softening economy and whether it gets too soft, right? Like
Yep.
this is on like the 2-year dot plot for the Fed for unemployment. They had us back in like March of 2022 or something at like 4.3% inflation right now. So we're on the glide path to the soft landing, but people are increasingly sensitive to it.
Yeah. Did you mean 4.3% unemployment right now? Or
Yeah,
no?
what did I say?
Yeah, you had inflation. Yeah.
Oh, yes.
Um,
Yeah, no. So I believe that they had us projected out in this like 4.3, 4.5 range in the
yep.
dot plot. So we're on their glide path. But we've become more sensitive to the weakening side than we were to the inflation side.
Yeah. Okay, let's get to our big three. There's a lot to discuss since I was gone last week. What a week to miss. A lot has happened in the last 2 weeks, so we'll just hit on sort of the high points. First of all, the volatility is clearly back with a vengeance after, similar thing. Like people have been complaining. I know certain options traders or maybe value mostly I guess options traders saying the VIX is too low. The VIX is too low. Red flag. Well, now it's definitely not. It had been in the 12, 13 range for weeks, months. Now it's in the 20s now, but that's only after spiking above 65, I believe, for just the third time ever. The only two other times were during the 0809 recession, Great Recession, and during the COVID crash in early 2020. It was short-lived. It's back to the 20s now, but still it's, in the 23, 24 range. The highest it's been in over a year since like March of 2023. What do you make of such a large spike and then retreat, but VIX is still high. I guess we were sort of overdue for volatility spike of some kind. What do you make of how much it spiked and where it is now?
We came into August. I'll just use August broadly with a really high level of complacency
Yeah.
in the market, right? The VIX is an aggregate measure of the amount of options contracts traded on the S&P for like the next 30 days, I think is what the calculation is. I don't have it handy. My apologies. But it's sort of a measure of how much insurance is out there, how actively large investors are buying insurance, and they hadn't been, for a couple of reasons. One, we've been on a tear pretty much straight up since October of last year, and the second one is there's still a ton of cash on the sidelines. So if you're not fully invested, you have less incentive to hedge because the cash is the hedge. Um, so we saw a lot of equity buying, and we've talked about how how a lot of institutional investors have been sort of non-committal with cash on the sideline, but they were largely fully allocated to at least big cap stocks, especially like big cap tech. So that that lack of hedging plus losing 10% on a major global index, right? On the Nikkei, it's a $6 trillion market, so it's not nearly the size of the US, but like imagine if the UK lost like 10%, right? It's sort of it's Black Swanny.
Yeah.
There's structural reasons that I think it happened the way it did, but it's certainly enough to remind people to go out and buy insurance. Um, and in the moment, it feels like, oh, is this the end of the? Are we going to see like an unwind of the global financial system? What's happening?
Yeah.
Uh, but
Yeah.
it,
Sorry, go ahead. Finish your point.
oh yeah, it doesn't. As of right now, it does not seem like there's going to be a lot of sustained volatility.
Yeah, I think the degree of the spike reflected um most people will get into this in just a few minutes, but most people don't know what the heck carry trade is, and they didn't know why the Japanese market was down 12%. When they hear worst since 1987 crash or whatever, and then you see the domino effect across every market as they opened across the world. Just sort of the unknown of it all, I think, is why there was such a spike, because people just like, what is this? Is this the end of the market as we know it, or are we going plummeting straight into a bear market, that kind of thing. And then once people sort of wrap their minds around it, it went to sort of normal levels of volatility, which it is now high, but you know uh, with all the sort of factors out there now between the jobs report, the disappointing jobs report last Friday, and uncertain, Middle East, escalating Middle East turmoil, and uncertain presidential election, everything. Volatility being high now makes a lot of sense, but this level of volatility um, seems like more of a peak than you know. I don't think we're going to go back to 60 anytime soon, or even half that.
Well, yeah, and if we've got if the VIX is at a higher sustained level, it may just be factoring in that people are implementing more hedging than they maybe had been, coming from a place of complacency. So if the
Right.
VIX hangs around 20, that seems like a pretty reasonable
Yeah.
outcome, where you can still have a sustained bull market. It's just insurance becomes more expensive because you've got higher implied volatility and more people buying puts and stuff like that. So there's maybe a little bit of a change of character in how people are pricing risk, but it's not. I mean, we're still in a technical downtrend in the U.S., but the Nikkei bounced back like 9% the next day, right? That was sort of
Yeah.
a blip.
Got a good stat for it. I just pulled this up. Um, the VIX, so right now it's actually down to 22.4 uh, on August 9th, 2020. So 3 months prior to that election, it was at 22.05. So it's exactly the same almost. So yeah, I would say expect to. I could see it remaining in the 20s. Looks like it was for pretty much up until the election in 2020. And 2020 was obviously a different environment, so maybe it'll be
Yeah.
more. That was right in the midst of COVID. So
Where did it like settle? What was the lowest it got after it popped in 2020 before it came?
well, so yeah, it got to 66 in March 2020.
Right.
Settled, like the low was 22 pre-election. So we were at the lows. Right after the election, it went from 38 all the way down to um, 20 by the end of November.
Yeah.
And then,
It's
by 2021, it was back in like the teens.
I
Uh,
think historically the VIX sits around like 1920.
yeah, I think that's right.
So
Yeah.
yeah, I wouldn't sweat that. I wouldn't sweat the VIX being at 22 right now. Seems like
No.
a pretty reasonable outcome.
Moving on to the sort of the root of those fears, recession. Fears overblown, or was the Fed too late? What's your take?
I don't know. I was making sort of the dark horse case for a July cut.
Yeah.
The market has
I
been
wonder if
sort
they
of
wish they had now.
maybe. I don't know. It's higher for longer still. I don't know. The tough thing is like, right, we're seeing like the K-shape economy where the lower I don't know, lower two quintiles of consumers are really feeling the pinch. Excess savings are gone, but then like the upper two quintiles are in really good shape because the markets are close to all-time highs. And then you've got like that middle quintile where everybody's like, ah, stuff's more expensive. I should probably stop paying for DoorDash delivery fees, but I'll still go out to eat once in a while. And
Yeah.
I think the concern is, does the does the bottom 40% of the economy, is that such a drag that it starts pulling down the sort of upper 40% of consumers? Because that's when you sort of face the recession fears. For the time being, it's still tough out there if you are lower income. There's a lot of part-time jobs that are sort of supplanting full-time jobs. So instead of working one full-time job, you've got two or three part-time jobs, which can make the overall employment picture look a little bit better for like new job ads, or but like additions to the job count, not job advertisements.
Right.
Um, I don't know. I mean, this is one of those times where it's like uh, it could easily go either way, and maybe the economy stays strong, maybe the AI, maybe there's more juice to squeeze there, and then business spending picks back up, and then things start feeling better if you're in the lower income segment of the economy. Um, like that, there's that as a positive outcome. So I'm really on the fence. I don't think it's totally dependent on. I don't think the Fed actions are what's causing this right now, but I think
No.
they could help by cutting.
Right. Yeah. And I think they were going to start cutting anyway next month, but maybe that report, was the last. If they were like 95% going to do it, I think that report was the extra 5%, shove. And now people are projecting maybe they might cut by 0.5%, by 50 basis points. Let
Yeah.
me what the percentage is of that. Like close to 50-50. 54.5% think they'll cut it by 50 basis points next month. 45.5% think just 25. 0% think there will be no cut. I mean, there's going to be a cut. It'd be truly shocking if there's not a cut. So Tyler's going to have to drink hot sauce here by the end of the year for his no rate cuts through the end of the year take from a
Yeah.
couple months ago. But
Yeah, if there's no cut in September, that's bad news, black swan, like
yeah,
market contagion stuff, not like what we saw with Japan.
yeah.
Um, I don't know.
I think it's on the table that I don't think that it'll happen now, but there people were asking, a week ago after this, or I guess beginning of this week, feels like a full week ago, after all the sort of volatility and the fallout from it, would they actually cut between meetings, which is rarely happens, but I don't think it's going to happen. But that's where people's mindset were. So if they were not cut next month, that would absolutely blow people's mind. But it's 100%. Will it be 25 or 50? I don't know. I think people just see it. Does it matter a ton? I guess it matters in the sense that they're willing to really start, you know, pressing the accelerator on cuts if they do 50. But the headline will be Fed finally cuts rates. And that's what people want to see.
I can't. I mean, so neither of their two dual mandates changed as a result of the market having this spike in volatility. Ostensibly, they are obligated to like provide full employment and moderate inflation. Those are the Fed's two mandates. Neither of those figures changed at all because of what happened this week.
Yeah.
I I don't know. They have Powell has made an effort to make it make it apparent that he is not like beholden to equity investors. So I think there's probably
Yeah.
some resistance to making a 50 basis point cut. I can't speak for I can't speak for any Fed member, but I can't speak for the rest of the FOMC. But I don't know. I feel like 25 basis points feels about right.
And you and
Makes
I have been our noted Fed whisperers. We've been right
yeah.
way more often than not on what they're going to do. I think 25 basis points. And I bet even like expectations fall to they'll do 25 or rise to they'll do 25 basis points by the time it gets there because some of
Yeah.
this panic will have subsided. It already was. It was at 50 basis points, like 75% chance like days ago.
Yeah.
So I think that'll be the expectation, and that'll be what they do. Last thing, the carry trade, we mentioned it. I definitely knew what that was a week ago. No, I did not. I think like most people, most investors included, I had never heard of a carry trade. For people who still aren't sure what that is, we'll go smart guy podcasting now, and that obviously I'll defer to you on that. Explain what a carry trade is.
So the carry trade is essentially a borrowing cost arbitrage trade. Japan has had sub-zero, or I mean, now just barely above zero interest rates for decades. So what you could do if you're an institutional investor, you could go to a large bank in Japan and you can borrow money for free, essentially. I mean, like 0.5 or negative 0.5 basis points, right? Like you could actually get paid to borrow money feasibly, although I think in practice it's closer to 0%. And then what you do is you take the money that you've borrowed at 0% and you go and you invest in other assets. The super safe version of that is you go and you buy like T-bills. So you're borrowing money at 0%. You put every single penny into a T-bill that matures in 90 days, and you're effectively getting, 3 to 5% depending on treasury rates for free, because the money that you're putting up is not yours. It's borrowed. You're not paying to borrow. So it's free money. Buffett did it. He, I believe, bought Japanese financial stocks with his carry trade money. One, there's no way for us as investors to see who was deploying the carry trade, where they were putting the money, or how much they had. I've seen JP Morgan estimate that it was a $4 trillion trade in total. So total borrowing from Japanese banks, 4 trillion. That money's then redeployed into other assets. Based on what was selling on Monday, I think you had obviously Japanese equities, but that was partially due to liquidity. Because if the carry trade is falling apart because, say, you have a strengthening yen, that makes it more expensive to repay the loan because you've taken yen, converted them to dollars, and now you're deploying dollars. If the yen gets stronger, it takes more dollars to pay it back. So the yen rapidly
What triggered like the angst or fear about this? Bank of Japan raising rates. Yeah.
Yeah. So they're raising
unexpectedly.
Yeah, so they're raising rates. That makes it more expensive to carry the carry trade. The yen starts strengthening. That makes it more expensive to sustain the carry trade as well, because it becomes more expensive to pay back. And you add into that we have been sort of topped out with the growth equities. And there was this rush to the exit to close things out to basically repay these Japanese loans. One thing that we saw, like the Nikkei was down almost 15% intraday, down 12%. That seemed to have been more of a liquidity thing than based on the assets that were underlying it.
Yeah.
So when Japan is the only market that is open, you can only sell Japanese equities. So if you're forced to repay these loans, or if you're rushing to the exits to repay these loans, you're selling whatever you have that has liquidity to support it. And once the Eurozone opened up, that's when we saw the Nikkei start bouncing back, because you could start selling European equities.
Right.
And then once the US markets opened up, US markets open up much lower, you can start selling that. You are repaying the loan with proceeds from US equity sales. And then we get this really quick bounce back because people reallocate money that they wanted to have in Japanese equities into these oversold assets. It was a liquidity crunch that was very short, all because this one big trade is unwinding. It may not be fully unwound yet. I've seen, I believe, JP Morgan again saying it's like half unwound, but it was a weird blip that was a result of just Japan having a really small market size and being the only place that was open for business when these loans started needing to get repaid.
Very well explained. I have no notes, and I don't think I have the right notes, even if if we were to have any. Yeah, so that's the carry trade for you. It's a good bit of carry trade 101 there. Okay, let's get to our guest, Ben Reynolds, CEO and founder of Sure Dividend, in just a second. Hey, we welcome on Ben Reynolds. Ben is founder and CEO of Sure Dividend, which helps investors build and grow high quality dividend growth stocks for the long run. Founded in 2014, serves more than 8,000 premium members. Ben, welcome to the show. And first, Brad and I were just talking about, the elephant in the room right now, the volatility, the VIX spiking above 65 earlier in the week and everything that's going on. I wanted to get your take on it from sort of the dividend realm and specifically dividend growth realm. Does volatility help you and your audience? Just is sort of a safe haven. People flock to you guys a little bit more in times like this, or what's your perspective?
Hey, Chris and Brad, thank y'all both for having me on. And yeah, for volatility, so I wouldn't say it really helps or hurts. For dividend growth investing, we try to take a long-term approach to that. So the main thing I tell people and what I try to do myself, and it is easier said than done, is to focus on your dividends and your dividend income, and if that's growing, and less on current volatility and current share prices. If you do that, it's less impactful and it makes it a little bit easier to hold through these really volatile times, which have been crazy lately.
Yeah.
Now, are you looking at some of these days where like the Nasdaq is down 4%, 5%, saying, "Hey, we were already targeting some of these dividend payers, maybe something that's sort of tech adjacent," and saying, "Hey, this is a good opportunity to accelerate that," or are you really just focusing on structurally deploying capital, where it's like, "Hey, nope, it's once a month, it's once a quarter." Do you have a tactical bent to your investing, or
Um, we typically don't have a tactical bend. If you are taking a tactical approach, I mean, I think now's a good time because there has been a sell-off and you're seeing some better discounts on some dividend names. At the same time, in the quality dividend growth area, the sell-off hasn't been quite as much as it has
yeah?
been with the faster growing tech stocks.
Right, and you mentioned dividend growth is sort of your bread and butter. Dividend Kings in particular are something that you guys really focus on. Explain what Dividend Kings are, because probably, not a term that our audience is quite as familiar with, or many of our listeners.
Yeah, so one way to look at different dividend growth stocks is to look at their dividend histories. And the dividend kings are the best of the best in dividend longevity. To be a dividend king, a stock has to have 50 plus consecutive years of dividend increases, which, it's 50 years is a long time. And when you really think
Yeah.
about what that means, these are companies that they've managed to increase their dividend every single year through wars, recessions, changing technology. I mean, I guess 1974 was
Right.
technology was different in 1974 versus 2024, and to be able to increase your dividend every year through all of that is a very rare and special thing.
So basically, dividend aristocrats on steroids,
Yes.
or lots of steroids. So how many are there? There can't be a ton in that realm, are there?
No, there's only 53, and that's including companies that are dividend kings through spinoffs. Like an example of that would be like 12 years ago or so, Abbott Labs spun off AbbVie, and
Yeah.
we count both of those as dividend kings because AbbVie kept increasing its dividend. Um, and I wanted to touch on too, you mentioned the dividend aristocrats. There's 53 dividend kings. I think there's 68 dividend aristocrats.
Yep.
And to be a dividend aristocrat, you need just 25 years of dividend
Right.
increases, which is still incredible.
Yeah.
But there's also the reason there's not that many more aristocrats than kings is the dividend aristocrats index is constructed by the S&P or S&P. And so a dividend aristocrat has to be in the S&P 500, whereas a dividend king does not. So you'll get some smaller companies. There's like a regional bank as an example. That's kind of shockingly a dividend king that isn't a dividend aristocrat. So that's kind of a unique structural thing where you're not having this arbitrary, somewhat arbitrary constraint of has to be in the S&P 500 index.
How many are not part of, how many of the Dividend Kings are not part of the aristocrats, right? Like, where's that Venn diagram fall off?
I don't know that one off the top of my head. I would say there's, if I had to guess, I'd say it's something like 5. It's almost all kings are aristocrats, but there's a couple that aren't.
Interesting. And with Dividend Kings, I mean, the companies that have that kind of liquidity and are able to raise dividends for 50 years, I mean, is there much of a sacrifice in share price gains, or, you generally just see sort of steady performance in terms of the share price?
I mean, it does depend. Like the fastest growing non-dividend stocks are always going to have, the ones that do well are going to have, better capital appreciation.
Right. Yeah.
But a lot of Dividend Kings have done extremely well over the long run, so they have had a lot of capital appreciation as well. Just when you think about it, for the dividend to grow, earnings per share really have to grow.
Right.
You can't raise the payout ratio 50 years in a row. I guess, not in reality. So since the earnings per share are growing, the share price has to follow that at some point too. So there should be capital appreciation. Really, if there isn't over a long period of time, then that's probably a warning sign, really, that king might not be a king for much longer.
How much importance do you put on, with all of Sure Dividend's products or coverage, do you put on dividend growth rate? Because a lot of this, like the aristocrats and the kings, are based on dividend sort of growth longevity. But do you have something that looks at the growth rate where it's like, hey, these guys are doing everything they can to funnel as much money to shareholders, and we think it's worth calling out?
We do look at dividend growth rate. We actually look at earnings per share growth rate more than dividend growth rate. And that's because I've seen some companies where the dividend growth rate looks phenomenal, but it's because their payout ratio went from 20% to 80%, and you're not going to get that growth again. So we put a lot of importance actually on earnings per share growth, or similar, like depending on if it's a similar metrics, but basically earnings per share growth.
So
And I know
that
there's
seems.
other. Sorry, go ahead, Brad.
Oh, I was just going to say that seems like a handy takeaway for listeners that are looking at the dividend payers. Instead of prioritizing how quickly they are growing their payout, which is very subjective at the discretion of the board and management, to focus on the business's actual fundamentals and the growth there.
Yeah, I completely agree. And that's one thing I've always found. It's one of the things that actually got me really interested in dividend growth stocks is when you think about I try to think of them think of the underlying business, kind of like what Warren Buffett says, you're not buying a stock, you're buying a business, or a tiny piece of a business. And the really long dividend streaks, what's interesting to me about those, one, it's a shareholder friendly management culture. But two, it's evidence that they're, at least up until recently, is a really strong and durable competitive advantage. And because you can't grow your dividend and your earnings for so long unless you have such a strong advantage. And so it's kind of a shortcut to seeing that.
And I noticed from your site you have other sort of categories of dividend growth stocks. I can't remember the names of you guys have some pet names for them. Can you just explain just what a few of those are?
Yeah. So I want to say too, I didn't come up with any of these names. These are other people have come up with them,
Yeah.
whether they're companies or individuals. But to break them down, so there's the non-index owned ones. And that's the highest tier is the Dividend Kings, the 50+ years. Then there's the Dividend Champions, which is 25+ years. And then there's Dividend Challengers and Dividend Contenders. And one of those is 5+ years and one is 10+ years. And then there's the index owned ones that kind of parallel those, but they also have additional constraints of being in specific indexes. And that's the Dividend Aristocrats, Dividend Achievers. And just recently, S&P released I believe it's the Dividend Monarchs, which is their Dividend Kings.
So by not being indexes, you mentioned less constraints on both dividend, basically on dividend growth. Is that where you?
Well, if it's not an index, I think it's an advantage for it not to be an index.
Yeah.
because you just lose the constraint of like has to be in the S&P 500 or has to be in, you know, a
Gotcha.
specific thing that that company owns basically.
Right.
Have you been, do you hear more from your readers and your subscribers when we have market periods like this? Is it just a lot of coaching people off ledges and saying, "Hey, no, stick to the system"? What do you hear from your readers in times like this? When actually, this will be two parts. One, when growth stocks and the speculative plays are at all-time highs, and then two, when the markets start correcting lower. What are you hearing from your subscribers in times like this?
That's a really good question. So, when there's a lot of when really speculative stuff is doing well, um, I'd say it's kind of there's sort of two parts to I guess the business side of this. People joining because they're interested in dividend stocks, and then people churning or leaving because they're not interested in dividend growth stocks anymore. So what I've seen is if all investment styles tend to go in and out of style or have, you know, different relative performances. So for much of the last 5 to 10 years, tech stocks have absolutely crushed almost everything else. And so when dividend stocks are underperforming on a relative basis, we tend to see less people comparatively get interested in join, less new people. Still, obviously, people are interested in joining, but just
Sure.
but as long as dividend stocks, if the market's not super volatile, we see more people staying on. And then when the market gets volatile, we see typically dividend stocks, high quality ones tend to outperform when there's more volatility. They're still going down, they're just going down less. So, but comparatively, it looks better. So we'll actually tend to, at least historically, we've seen more people join during those times, but we also see an elevated churn rate because I think there's just more fear in general out there. So
Yeah.
that's
And that totally aligns with, you know, because we're at Cabot, we're not just dividend specific. We have dividend newsletter. We do have a dividend newsletters, but also growth and small cap and global stocks. And, you know, right now, when you look at, you know, portfolios, the ones they're sort of holding up the best, just at least in just the last month or whatever, are the dividend advisories. You know, Tom Hutchinson, who runs our dividend investment advisories, you know, that's where, you know, I guess that was the first question I asked is this volatility good for you guys? Because, you know, you're sort of like, you're almost like gold, you know, a safe haven for investors.
yeah, it is. I think it does help. I know during like 2020, we had a lot more interest, but we also had more churn because people were just so scared.
Right.
No.
Right.
And I started Sure Dividend in 2014, so I don't know what will happen like on that basis if we had like a 2009 style event. But
Right.
on one hand, I'm curious to find out. On the other hand, I, you know, prefer not there to be a massive recession.
Yeah.
So
Well, you made it through a pandemic crash, short-lived, but you know, wasn't nothing. So 10 years in, you've, you know, well established. So
yeah.
so
As
go
as
ahead.
somebody that was talking people through investments in 08, 09, a lot of, hey, is the investment doing what you hired it to do? Is it paying you a dividend income? Is it continuing to support your lifestyle, your retirement, et cetera? That was the flavor of pretty much every conversation I had with long-term investors and value-oriented and income-oriented investors. It's like, hey, you hired the stock to do a job. That job is to pay you income. It is continuing to do so. Unless the business fundamentals have changed, your perspective on it shouldn't really be changing either. But that's
I
me
think
reaching deep back into the memory hole.
I think that's exactly right. I mean, that's what I try to say, kind of to prepare people, focus on the business, and then hopefully, you know, you never know for sure which stocks are going to do poorly because each recession is different. Like COVID was hard on brick and mortar because lockdowns aren't great for going to stores. Um, but some of those companies did super well in 2009, like a Walmart or a Costco. So you never know exactly, but I completely agree with that. advice or recommendation of look at the business. Is it still paying you your dividends? Is it still the same company, just the share price is cheaper? So in theory, you should be buying more. I think that makes a lot of sense.
Yeah.
Dude,
And as we've heard with the Dividend Kings, there are 53 of them at least that made it through COVID and many other things. High inflation in the late 70s and early 80s and 87 crash, everything. Brad, you had one more thing.
yeah, do the Kings skew in in the direction of any particular sector? Is there anything that you see sort of overrepresented in those?
Yeah, that's a great question. So they definitely skew. They're heavily skewed, actually. There are no tech stocks that are Dividend Kings. None are even close. There's only one REIT, and I think it's because REITs weren't even around really 50 years ago, just as an asset class. There are very overrepresented are utilities, and I actually recently wrote about this. Utilities are extremely overrepresented by about a factor of 10 relative to the amount of utilities there are. So utilities are the best companies, if you had to bet, that are likely to pay a rising dividend year after year. And that's because they're natural monopolies and government regulated. And if they're in an area that's growing their population, I'm in Houston, I will say. And so I will say, if they're not horribly mismanaged, the utility here is, in my opinion. But yeah, so utilities are heavily overrepresented. Consumer staples are very overrepresented, and that's your Coca-Cola's,
Right.
Colgate, companies like that. And then somewhat surprisingly, maybe not surprising, but industrials are also pretty represented in there. And we actually just lost a Dividend King in 3M. That was a kind of a long-term dividend grower that recently cut their streak. But industrials are also overrepresented. And then everything else is just kind of in the middle there. Healthcare, there's a lot of healthcare too.
Well, if you want access to Ben's and Sure Dividends Dividend King spreadsheet, it's a free download. We included a link to where you can download it in the blurb below this video if you're watching on YouTube. If you're not, if you're listening to this, you can go to the Cabot Wealth Network videos YouTube page, and you can find it there. Also, suredividend.com is the website. Anything else you want to plug, Ben, before we let you go?
No, thank you. Yeah, that resource is available for anyone listening. It is a free download, like Chris said, so there's really no reason not to get it. It's a spreadsheet just to see the 53 Dividend Kings, and we have like dividend yield, number of years of consecutive dividend increases in there, things like that.
Well, it's a good time to be in dividend stocks, that's for sure. Ben, thank you for joining us. And thanks everyone for joining this week's edition of Street Check, and we'll see you next week.